Okay, it's time for our dinner speaker. First, Nancy, do you want to tell people about their CPE credit? Maybe not. So I'm going to go ahead and introduce Bryce. Oh, here we go.
I'm sorry, I'm here. Yes, today's presentation for this evening is worth 1 CPE credit. To be eligible for that credit, you need to answer 3 of the 4 polling questions during the presentation and viewing time of at least 50 minutes. All of you know the rules about CPE credits. We will send you a notification in 7 to 10 business days when the CPE credits have been released.
All right, I wanted to introduce Bryce Moen. He's a member of our programs committee. He's also Vice President of Accounting for Teal Natural Resources and President and founders of Chandler Speaks, a 501c3 committed to providing speech pathology services to disadvantaged youth. Bryce?
Thank you, Ron. It's great to see so many friendly faces out here as we migrate back to, I guess, normal behavior during the pandemic, or at least trying to. Tonight, we couldn't have a more fitting speaker in terms of the dynamic real estate market that we are currently facing, in terms of robust growth in certain areas, while significant retractions in terms of leasehold space for other markets as well. Tonight, we have the honor of hearing Brad Sellner speak. He's the president of the South Central region of Jones Lang LaSalle. With oversight of this region, he oversees the Dallas, Fort Worth, Kansas City, Austin, and San Antonio offices. He oversees 500 plus employees and oversees several segments of the business, from tenant representation to capital markets. He brings a wealth of knowledge and experience to Jones Lang LaSalle through a number of years. He earned his Bachelor's of Finance from the University of Texas, and he's actively involved in philanthropic efforts here in Dallas, which includes Downtown Dallas Inc., High Ground Advisors, and the Salesmanship Club of Dallas. So without further ado, I'd like to have Brad Sellner come to the stage.
Hey, thank you very much. Appreciate it, Bryce. You want to do a little mic check here? Are we good? All good? Everyone can hear me? Excellent. Well, I'm going to state the obvious. It's been at least a year since I've done something like this, right? I mean, when was the last time we've all gotten a chance to come in and actually be with one another in a, in person and talk about business and what we're doing? I don't know about you, but I jumped into the office on Monday morning, kind of hoping that 2021, here we go. We're going to be back at it, be in the middle of blowing and going. And I went out and I started touring some office space, only to find out that no one was in the buildings, just like the end of 2020. So let's hope we're on a trajectory here. This is a great sign that we're going to get a chance to get back into living a little more lives that we're accustomed to. So I'm gonna talk about 2 things today. And first off, I'm going to give a little update and assessment of the Dallas real estate market, just because that's kind of my specialty, and hopefully that is relevant to you. And then I'm going to attempt to hit a topic that a lot of us have been struggling with, which is, hey, we've moved through a period here over the last 10 months now. Maybe it's going to be a year, 14 months when we get really back into our offices, and talk a little bit about, the future of work and how we do that. And I'll give you some of our thoughts on this topic. But before I do that, what I thought I'd do is just talk a little bit about our company. I've got one slide here. I promise this is not a sales pitch, but so JLL is a real estate services organization. We're a global organization. We have about 90,000 plus employees. We're growing like crazy. And we really have three primary businesses that we operate. One is called the market side of the business, and that's the business that I'm in. That's the business that Connor McCarthy's in, which is really the leasing, the management, the construction of commercial real estate assets across the country. We have a capital markets business that some of you may have be familiar with the company Holiday Fenolio Fowler, HFF. JLL purchased HFF last year. They're a best-in-class capital markets business, and that's the selling of assets, but also financing and putting equity on it. And then lastly, we've got a corporate services business, which is, if you're a big, major Fortune 500 organization and you want to outsource everything, our firm will come in and do that. By example, Burlington Northern Santa Fe is one of our biggest customers. If you ever have a real estate dealing with them, there's a really good chance you're talking to someone that works at JLL as they would operate it. So just from a macro standpoint, I thought I'd point that out. Bryce mentioned that I serve as the president of the South Central region, which is our offices here in Dallas and Fort Worth, San Antonio and Austin, and Kansas City. And boy, am I fortunate to be in this part of the country in the real estate business. This is a really good place to be. That's enough about us. I wanted to share this slide because, you got to have an eye test every now and then because there's a lot on this page. But so back up in time, it's March of 2019. Right? And we're all sent home. We're at home. We're working virtually. And we're looking at the economy and everything that's happening. And we're trying to figure out what on earth is going to happen to us as an economy and in the real estate side of the business, most notably. What you have here, and I was hoping this would be a little more visual for you, but I'll tell you the important point, which is, had you asked me then what the potential ramifications were to real estate lessors on the industrial side of the business and office side of the business and retail side of the business, I would have said there's no telling. I mean, we're in the middle of a huge potential correction, okay? So in the US, we manage about 20,000 commercial real estate assets, give or take. What you see here is a rent collection report, okay? And I think I got a marker. This top one is the industrial segment of business, okay? So these lines represent historical collections year to year in comparison to current collections year to year. So what you see here is the industrial side of the business has performed about the same as it did at the end of 2019. Obviously, e-commerce has been a huge benefit to that. So the losses were more than offset. I'll tell you, our business here domestically, our industrial business was up 40% year over year in 2020 in comparison to 19, up 40%. In a 6-week period, we signed 6 leases in excess of 1 million square feet for e-commerce retailers across the country. So huge boom on the industrial side of the business. This next graph here is office. And as you'll see, very close to the collections were the same as the year before, within 3 to 4 percentage points from one year to the next. I mean, that's shocking, okay? How many of you lease office space? Okay, how many of you went to your office 5 days a week for the past year? Oh, yeah, okay. Well, we got a couple of show-offs, but seven days a week. Okay. The point is that office space has been sitting vacant across the country, but tenants have continued to pay. This is outstanding. There's been a level of honor, whether it as a result of PPP, financial assistance, or just the fact that a lot of companies are doing really well. Law firms are billing, accounting firms are serving their customers. Not everybody's been impacted by this at the same rate. So that's a really, interesting component. Now, the third one is retail. And you'll see there's about a 40 percentage point differential from their historical norm to what the trend has been over the last several months here. So retail, for the most part, was by far the most affected in this latest downturn. Not surprising, because on the office side of the business, we can actually conduct business, ironically, very effectively remotely in some respects. Can't do that as a retailer. Either if your restaurant's closed, you can't make money. Pretty simple. So I thought I'd just set that as a tone from a macro standpoint. This is all national, not related to necessarily Dallas-Fort Worth. Here's the three key takeaways that I'd like to share with you about the current state of the market. First and foremost is that Dallas is way ahead of the rest of the country as it relates to our re-entry to office space and the recovery of where we are. I'll talk about that in a minute. Second point is there has been an explosion of sublease space or available space coming on the market. Pre-COVID, there was approximately 4 million square feet of sublease space on the market. There's an excess of 8 million square feet today. So we've seen a doubling, and frankly, I would expect that will continue to increase as companies get back into their offices, assess their business, see what their new needs are with this new work from home trend that we're dealing with. And some companies will look to kind of offset costs by doing that. I mean, particularly some of the bigger organizations. And then the third thing is that I heard a guy at Goldman Sachs make a statement about, big events like what we've dealt with here in COVID have a tendency to accelerate existing trends rather than create a whole bunch of new ones. I don't know if you find that to be the case in your businesses, but in real estate, it's certainly. And there's been a relocation trend to this part of the country for all the right reasons, all the right fundamentals, that is accelerating. So let's unpack this just, quickly. Here's another great slide that you can't read. I'll point it out for you. This is probably a bad example because this is actually, I think it was last week, which was kind of the 5th or 6th of January. Obviously not a full back to work week, okay? But here's what I want to show you. The average utilization, according to Castle is, most of us have a key card in our pocket of some type. Castle's one of the leading key card companies in the country. And they put out this study. If you go to their website, you can see it week to week. But Castle put out a study, and it shows the utilization. How many people are actually accessing their office space across the country? The average is 16.5%. So now that's low. But what I'll show you over here is this top green line is the Dallas metro area, the highest one. In October and November, the DFW marketplace, according to Castle, we had almost a 43% utilization of our space, meaning people going in, back to the reentry point. Chicago, less than 20. New York, down in the teens. So we're at least twice of the activity back into normal workflow than the balance of the country. And the reason that is important is that, once again, we don't really know where this, what the future will be, but we as a metro area are really doing our best to open businesses, get back to the normal pace of things, as evidenced by, doing what we're doing here today, much less playing, high school football. I mean, I don't know if any of y'all have high school kids. My son played football this past season. They had a season it was like any other year, right? Except that I'm sitting in the stands with my face mask on. So we're in a really good position overall, and I think we'll be the beneficiaries of that and see the recovery quicker than others. The second thing is unlike past big market corrections, DFW is unbelievably diversified. Okay, if you look at this graph here, you'll see the most diversified businesses, most diversified markets, highly cyclical markets, and then counter-cyclical. Washington, D.C. is a great example of counter-cyclical. Washington, D.C. is doing fairly well, other than the fact that it's closed down for most of businesses. Dallas is smack dab in the middle, and if you look here, is that this is a 10, and what that 10 is that the average number of quarters from trough to peak in past economic corrections. So where we're in the 10 range, you see a lot of these markets like New York and others, Boston, Seattle, they're in the 15 to 20 quarter time frame. Who knows, maybe we recover more. The other thing that everyone's sitting there saying, most of our tenant base is licking their chops. We're going to get great real estate deals and be able to do that. I believe that is the case in some cases. But this big solid line here, this red line, if you look at it, that's kind of from 1993 to today. These are the big economic corrections that we've seen in the 01 and then 08, 07, 08 corrections. Look at what happened to Dallas-Fort Worth. We kind of went up, we kind of came down, we kind of came up, and we're trending up this way. In comparison to San Francisco Bay Area, boom, boom, boom. My point there is that we don't go up as much. As a result, we're probably not going to come down as much. So from a expectation management standpoint, there are going to be some great leasing opportunities out there. It's not going to be half of what it was before. And in many markets, it very well may be half. Now, to the point I made before on, an acceleration of the existing trend, which is this area, DFW, is a magnet for corporate relocations. In the last 10 years, we've moved 144 headquartered companies from other markets. And this is a map of where they're coming from. You'll see, so I'll play to this side of the room for a little bit. These are the California ones. There's a lot of folks from California coming here historically, but look at where they're coming from all over the place. And they're coming here, as I mentioned before, about fundamentals. It is a government-friendly place to do business. We have a hard work and high quality of life mentality here in this area. And companies on some of these coasts, it's just becoming it's been becoming really, really challenging to justify, hey, why are we headquartered out here in very expensive, unbusiness friendly environments? Now, I thought this was an interesting stat right here. So the Dallas Regional Chamber, which, by the way, I've had the benefit of working with some of the larger corporate relocations across the country. We look at all different markets. Let me just tell you something. The Dallas Regional Chamber is the cream of the crop as it relates to marketing an area. You go to others, they don't even have it. They don't know what their stats are. They don't know where they're tracking. They don't know how they're going about doing it. But the Dallas Regional Chamber is actively tracking 98 potential relocations to this marketplace. 46 of them have come since March of last year when COVID hit. So almost doubled the interest and activity. And by the way, that number is going up every day. So that, much talked about, it is a very real trend. We have always been a magnet for big corporate operations because once again, most of these companies are looking for labor arbitrage when they're moving to this market, and we have the benefit of that. But what we're seeing now is a lot of investment related companies that are finally just saying enough's enough, we're out. And so we're seeing a lot of different, this is going to be a good market to be in for a long time to come for all the right reasons. All right. So that's the kind of state of the market in Dallas. Those, we're ahead of everybody else. We've recovered very quickly, and we're going to continue to move people here. Let me shift for a second about work from the future of work as we're calling it. We have, much like the e-commerce business, they said they did 10 years of transition in 10 months. I never bought anything online until this year. Now I actually went and bought some Amazon stock because I thought, golly, if I'm going to do it, everybody will do it. But anyway, that's a side note. On the office side of the business, this has been something that I never thought that I would experience, which is how can people be efficient and functional, do their jobs in a remote work environment. So on the right-hand side is the Department of, of course, right? Which means before COVID, 25% of people regularly worked from home, okay? This is a study that we did, about 2,000 people across 10 countries that JLL conducted. And here's what we found out. After COVID, 66% of people believe that they are going to spend at least one day working remote. 10% said I want out all 5 days. So that's only a small grouping. 6% 4 days, 18% 3 days, 21% 2 days, and 11% 1 day, okay? And 34% say never. I'm going to the office regardless. That's higher than what we would have thought. Now, as we look at what the employee preferences are, 72% want to continue to work from home. Look at this here. 75% expect their company to support that. All right. And so here's where I would say the big dilemma becomes. I've never met an employee on the planet, me included, that wouldn't say, oh yeah, I'm equally as productive working from remote. And by the way, and I don't like flexibility in the way that I work, right? So these are obvious, things, but we've proven that, look at American businesses, look at the stocks, look at the returns, things that are happening. And the reality of it is that every CEO that I've talked to over the last 10 months, they've said the number one surprise has been how productive their teams have been in a remote working environment, number one. And number two, their investments in technology have paid off in spades as a result of this effort. Because you can't work remote unless you have data centers in the cloud and other elements like that. So, I think the reality of it is a lot of these investments have paid off. The future of work is something we're going to have to working from home is something that we're going to deal with. the questions are, how do we really mirror the needs of the business with the desires of the managers and the wants of the employees, right? So all of you are running some kind of business. And I suspect that that's what you're trying to balance right now, is that how do I tell this person they got to be here 5 days a week, but yet give this person the ability for, you know, flexibility and moving forward. So what we looked at a little model here off of McKinsey did a study, and they came up with six potential outcomes of the future of work here. And, you know, one of them is, the top one here is almost entirely in premises, right? And there are access to talent questions, there are productivity questions, and there's cost of real estate questions. So an example of, hey, we're going back right to where we were before, limited people are going to work from home, you know, you're going to start to cut into access to some of your talent. And because some companies are going to be a little more flexible, and they'll offer a day a week or something like that. Productivity is good, but that's something we're going to have to figure out. Can we really measure the productivity and how efficient are people? And then once again, the cost of real estate is your most expensive if you've got big assets. On the bottom side is we're going 100% remote. I've actually had some clients say that they're going to do that. You know, obviously access to talent is the largest, the lowest cost of real estate, productivity to be determined. I think not every business falls into that element, but there might be some that choose to go that route. I would say there's very low probability in these top two. You know, 5% or less will go in that direction. The majority are going to work towards some kind of hybrid model that addresses what do we do, how do we do it, what are the right functions, and how do we manage that with overall cost outcomes. And a lot of thoughts being put into this. There'll be a lot of mistakes made. You know, here's reality. Anyone that tells you they know what the outcome is going to be, they're wrong, because it's just hasn't been proven, it hasn't been tested. And so what we're really doing is we're starting to look at it holistically around, okay, if you're going to begin to tackle some of these questions or some of these issues, what do you need to look at? First and foremost, you got to have a business strategy. And what is your business strategy and how does it align? You need to have a people strategy, because, by the way, if you're an estimator on construction plans or whatever, and you can do 3 sets of drawings at the office, and you can do 3 sets of drawings in a day at home, well, guess what? It makes a lot of sense to do that. My business is a little different. I can't do it that way, but the point is there's going to be some job functions that are appropriate and others that aren't. And now as an organization, you got to step back and say, okay, let's take all this in, let's figure out what we want to do and the reason we're doing it, and build a workplace strategy around that. What does your space look like? How do you evolve? And some of you might be in leases that you still have 5, 6, 7, 8 years. Some of you might be in leases that you have a year and you're rolling. You're gonna have a bite at the apple sooner than some other organizations. And so a lot to think about on that standpoint. And then finally, the larger groups, as you've got multiple offices across the country, you know, there's going to be cost implications in different polls. And I wish I could stand up here and say I've got the answers for you in terms of what those are. The reality of it is, you know, you just got to work through what is supported, what best supports your business, why you're making the decisions. But the point is simple, okay? The point is that we've learned a lot as a result of the environment that we've come through. It would be foolish for any of us to think it defaults right back to the way it was before. It won't be 100% remote, but the answer might be somewhere in between. And and how will users use space as they move forward is a question for each individual group to really kind of come to the right answer. So now 7:10, I think that's pretty close to what you'd asked. I'm happy to take any questions that you have, or what's next. Yes.
Yeah, my question is, with all the companies that you see talking about being carbon neutral or whatever that phrase is by a certain date in the future, how is that impacting your business, maybe the investments you guys have to make to enable those companies to realize those environmental objectives?
So by the way, that's a really great question, because the whole green initiative, do the right thing, had a huge movement before COVID. And a lot of people like me were kind of like, okay, well, hey, it's one of these things nice to do when you do it. I tell you, frankly, we're hearing more and more companies today take the position that we've got to do something about it. Okay. I'm going to call it like an early 19 big movement in terms of basically, it was driven by private equity, right? To a large extent, finally came out of Davos and said, look, we're going to do something about this. We're going to make big commitments. We're not going to put money into companies that aren't supporting. We're not going to buy from vendors that aren't doing the right thing and helping the carbon footprints. But I don't know if I'm not answering your question, but that's something that more and more today that we're getting from our customers in terms of how do we do our part to be a responsible citizen, whether we're building a factory, whether we're renovating interior office space, or whether we're building a new building and want to go get platinum, gold, LEED certification. Because it's I think what happened was, it started out as the millennial workforce. That was important to them, so there was an adjustment. But that adjustment has come all the way through to the people that are investing in these organizations, and they're taking stands basically saying, hey, look, we're not putting money in anymore unless you're doing the right thing as citizens. That's our take.
And you see the millennials coming into play. Now we've gone from the Gen X to now Gen Z, right? So how does that factor into the real estate? Can you repeat the question?
So the question is that what's the effect of the different generations on the workplace, most notably the millennials and Gen Z and Gen X. I mean, you all are managers. You can tell a difference in terms of what's important to different employees. Be interesting when you go through economic cycles sometime. It kind of has a way of recreating levels of priorities and what's important, okay? And I tell you, I know you moved me forward here, but let me go back to the presentation because I want to get the stat right. Am I on or off here? Okay, sorry, that's fine, no big deal. But the point is that for the first time, okay, in that study that we did of employees across the country, what was important to them, for the first time, the sense of purpose was ranked below a desire for a flexible work environment. Okay, so I think that remains to be seen. I think what my gut feel is that, my gut feel is we're just going to have to get back to work, and we're going to have to assess where we are. We're also going to be, I will tell you first and foremost, the expectation for safety and wellness in the workplace is going to be paramount. So, how we do that is going to be a big question. That's going to have effects on the density of office space and what all generations will be willing to accept in terms of their work environment. And so I think that that whole component right now has been thrown up in the air, and we're very much in a discovery, wait and see, let's assess where we are and how we move forward. There was a question back in here in the light. I can barely see it.
Sorry about that, Brad. My name is Tom Washington. Is there any general migration away from downtown office space and out to suburban office space? I know I saw it reversed a while back, and now it seems like it's going out the other way again. Have you seen that?
Yeah. So the question was, the question was, what effects are happening to the desirability of suburban office environments versus urban office environments. Here's one thing that I'll tell you, back to the point in terms of where we are. Our lack of reliance on public transportation has put us in a position to recover and re-enter much faster. I talked to my counterparts in Boston and New York and San Francisco and other markets. And they're not concerned about coming to JLL offices in that area. It's just everything they've got to do in order to get there, right? So if you're commuting in from Connecticut, it's planes, trains, and automobiles. Some of you may have done it in the past. And there's just jumping in your car and driving in and parking your office building is not an option, right? So, but we kind of live, even in our downtown market, we kind of live in a semi-suburban environment relative to Manhattan, Chicago, and these other really big cities. So the trend remains to be seen, okay? The trend is not yet developed, I should say it that way. But we are hearing a lot of questions around from people that are looking at relocating to like, hey, we want out of this public transportation reliance. We want out of these markets that our people can't get to and from easily. And if you noticed on that McKinsey study in the middle, this whole concept of rather than having one big headquarters, that you might have multiple hubs around a city that put people in a position where they don't have to go into downtown Manhattan. They might be able to pop into Connecticut or go into New Jersey or some other place, and they've got other ways to access the environment and the feel to be around their people. And who was that? Okay, now, and Connor just referenced Haynes and Boone. So now Haynes and Boone is actually staying down there. We were fortunate to represent them. They're making a big commitment to Uptown. But Haynes and Boone did take their technology division and move it into Legacy West. There might be others. Yeah, there might be others. So I really haven't experienced that here. We've had a number of different groups that have considered, what do we do? But once again, even our core downtown market is nowhere near. You can still drive there. You can park your car. You can make it into your office. It's not like some of these highly congested, dense urban environments. I think we're going to benefit from that. Yes, question.
Yes, Bill Wallace. And what do you
Hi, Bill.
What do you view as your biggest hurdle over the next 12 to 24 months in commercial real estate? Your biggest obstacle?
Repeat the question. What is in our business in real estate, what is our biggest obstacle over the next 12 months? Okay. And thank you for asking that question because that's something that we all need to be thinking about in our businesses. Here's what I would say. Okay. It kind of goes back to the point I made. I show up January 5th, I'm rocking and rolling, I'm ready to go. And the issue is that not everybody's with me. I'm in the real estate in business. I have a vested interest in office and those environments. I think it's going to be having the patience and being in a position to really advise people and help them work through some of these issues on their time frame, not my time frame, right? Because I tell you, the other thing that surprises me is that, you know, when you take the smaller businesses, so I'd say, let's say 10,000 square feet and less, that's actually back at a fairly robust pace, maybe 50% of pre-COVID levels. I mean, there's a lot of good stuff going on there. When you look at the big users, it's probably 10%. I mean, go drive around in Plano. And I tell you, I'm talking to those CEOs. They are in no hurry to get back into their space. And that frustrates me, but that's just the reality of how they assess the state of their business, the health of their business, the priority around safety and security of their employees and the risks associated therewith. And then, hey, we'll get there at some point, is kind of the feeling that I'm getting. As regards to what? Yeah, good question. So the question is, take the big Texas cities and how does DFW measure up to these other cities? Let me just kind of run through that. At the beginning of in March, you know, when this first happened, Houston got a double poke in the eyes. You know, the old Three Stooges thing, and it was the oil business basically had blown up, and they were struggling from that. Now COVID hits, so it was down in the dumps. I would say, and back on that graph around, they're not nearly as diversified. You know, it's been good in a lot of cases. It's not so good right now, not nearly as diversified. So Houston is definitely behind, trailing the balance of the Texas cities, okay? DFW is gotta be one of the top ones in the country in terms of strength, health, vibrancy. I mean, our businesses, the businesses I run there, from a standpoint, we're down 15% last year. I mean, and that's with us doing no transactions in April, May, and even part of June. We're now 15%. Fort Worth they beat their numbers from the year before just because they moved into different areas. So now what I will say, take where Dallas is and put Austin on top of it, because Austin is fire hot. And Austin, as you know, once again, the trend, they were migrating towards the Silicon Valley of the South. They will be the Silicon Valley of the South. If you got real estate that you own in Austin, don't sell just yet, because it's going to be worth it. It's going to be worse. So I think the days in Austin are going to be interesting. Although we've had a couple groups that have considered relocations to Austin and have chosen Dallas, because Austin has some of the issues that Dallas doesn't have. A lot of traffic congestion. Government is an issue. They got a homeless population down there that they're just still trying to figure out. So there's definitely some challenges there that big cities deal with, but that market is extremely strong right now, relative. Question about.
You mentioned that the DFW loves to get relocations, and we have a lot of advantages. What are potential dark clouds on the horizon that we need to just be aware of?
Dark clouds on the horizon that we need to be aware of as a result of some of the that could impact some of the advantages that we have. That's the question. So there's one that I believe, and there's one that everyone's probably thinking about. Okay, the one that I believe is, Dallas has been a very inexpensive place to run a business, largely because of the wage rates in this part of the country in comparison to the coast. We did a study, and it was, if you're an average millennial earner in comparison to an average millennial spender, what market do you have positive leverage or negative leverage, okay? If you're living in the Bay Area, you're about 5,000 in the hole, just opening your eyes, right? If you're an average both, I mean, you're losing money every year. You just can't support it. A lot of other big markets, New York's like 3,000 in the hole, whatever. DFW is the only major market that you were about $1,200 positive, okay? So my biggest concern is frankly that we can't grow the workforce population at a pace that jobs are coming into the market, and that causes, you know, in essence, inflationary pricing for businesses trying to operate here. That's my biggest one. Now, the other one that has made it onto t-shirts and everything else is, you know, Californians come, but don't bring your politics, right? And yeah, and that's either something to be concerned about or it's not. That's the hook, right? I love it. Thank you. I got it. Yeah. Of course.
Thank you, Brad, for the great update on the real estate market. I want to close out the meeting. I'm going to repeat, kind of summarize some of the announcements because it seems that everyone involved but me had the wrong timeline. So some of the people online didn't get some of these, so I'm going to repeat them. The chapter meetings are planned for Tuesday through April and will be both in person and virtual. February's meeting will be February 9th. DCO's Financial Executive Awards are open for nominations. We have a virtual wine event planned for late February. The in-person winter social normally in February is going to be in May. And our spring social golf wine event is still scheduled for April. And members who did not get their one-time renewal discounts in 2020 will get it when they renew in 2021. And lastly, I want to once again thank our sponsors, our chapter title sponsors, KPMG, Strategic Partners, Financial Additions, and UMB Bank. Special events partner, Holmes Murphy and Associates. Our featured sponsors, Baker Tilly, Lockton, and Berry. And once again, anytime you have the opportunity, please give our sponsors a chance to earn your business. Thank you and have a good evening.